actual audio, but the video, tilt it a little bit this way. All right. That looks, I think that works. I mean, again, I kind of talk like, I'll have to talk like that. Okay. All right. So Mary Jo is here, and Karen Sparks. I'm going to go ahead and make a little note here.
She's a certified divorce financial analyst. So she helps people. You want to tell them what you do real quickly, Karen?
Yeah. And you'll need to talk a little bit louder. Okay. Yeah.
Karen?
Karen? I can hear you, but I don't hear you as clearly
as Edward?
Okay. Yeah, as I'm hearing it.
Edward.
I hear Mary Jo.
Yeah. Okay. So I go by Eric. I go by Edward. We have Mary Jo and we have Karen. Okay. Just want to make sure I get the players because I hate the name Ed, so I always go by Edward. All right.
All right.
Okay.
Appreciate that.
Sure thing. Now I always got to let people know. Okay. And so we're going to introduce you as a certified divorce financial strategist. Analyst.
CDFA. Okay. It's a certification.
Oh, it is. Okay. Analyst. There we go. That's how we spell that. Okay. And okay, so then there were some questions here. Some of these mic things are a little bit too low. Okay. So there were some questions here that you had. What is a CDFA advantage? And then what motivating factors led you to develop a practice serving divorcing clients in this capacity? And then we'll talk a little bit about how the services of CDFA can be applied to different practices such as litigation, mediation, etc. Could share a few case studies. Obviously, you're not going to name names.
Correct.
Apply to real estate. Okay. And then what are key considerations for clients interested in retaining services? Okay, that's good. I like that. Do you want, Mary Jo, do you want to hold on to this?
Sure.
Okay. All right.
Just let me know when you guys are ready, because I don't know when we're ready.
No, okay. So what I'm going to do is I have just a little intro here. When you eventually hear me say our special guest is Karen Sparks, a divorce certified No, hold on.
Certified divorce financial analyst.
There we go. Had it written down. Certified
divorce financial analyst. She's the co-author of The Stress-Free Divorce, Volume 1.
Okay. Yes.
All right. That's how we'll do it. Okay. So then I'll say, welcome to the best of investing. That's when you can say, welcome. You say, yeah, thank you very much. And then we'll just have Mary Jo start asking you some questions, and then I'll chime in, and we'll go from there. How's that?
That sounds great.
Okay. You all set, Mary Jo?
Can you hear me okay now, Karen?
I can hear you. Yes.
Okay.
All right. So here we go. Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, and my co-host, Mark Hanf and Nam Phan, are not here today, but we do have our other special co-host, Mary Jo LaFaye. And our phone number is 888-912-1190. You're going to use that number to answer the trivia questions for a 5-pack tanning certificate given away during this show. And the certificate's not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. Today's trivia theme is general trivia. Our special guest today we have on the phone is Karen Sparks, who is a certified divorce financial analyst. I got that right, didn't I?
You certainly did. Good afternoon, everyone.
Good afternoon. How are you?
To be here, and I'm happy to be on the program this afternoon.
Thank you. So, Mary Jo, you got some questions for her?
Yeah, I do. I've been thinking about what you do, Karen. I'm wondering what motivating factors led you to develop a practice serving divorcing clients in this capacity?
I looked at it from a couple of angles. One of them certainly personal. I wanted to find a way to bring together the financial knowledge that I had gained in the private sector as a CFO and business manager, together with the legal knowledge and the legal experience I gained in that field over the years. And I also wanted to merge that in order to be able to serve clients better in this space.
And so, so let me ask you, when I introduced you as a Certified Divorce Financial Analyst, a CDFA, that's actually a specific designation, is that right?
Absolutely, yes. It is a designation issued by the Institute of Divorce Financial Analysts, and that's where I took my training from. And we go through very rigorous training in an attempt to really focus on all the nuances that are involved in couples coming through divorce and separation. And that's what we are trained to do and trained to focus on.
Which is,
so yes, that is a specific designation.
which is about half the marriages now, right? If not
yes,
more.
it is.
Yeah.
Yes, it is. Yes, about 50% of our population today, or a little less than 50%, are finding themselves in a situation where they're considering divorce or separation.
Okay, so do you sometimes meet with people actually before they get divorced, and sometimes you meet with some people after the divorce?
So there are several layers to my services being applied, and I have clients coming to me at various points in time. I do have those that are coming to me as they're considering the issue of divorce. It certainly hasn't been something they've communicated perhaps with their spouse, but something they're thinking about. So oftentimes they will come to me to talk about the positioning they need to have financially and how certain things will happen in that regard. Other times, I will be consulted for post-divorce tasks that have happened after the settlement. Maybe some things need to be tweaked or reanalyzed or re-strategized. And of course, the bulk of my work is done during the actual process of divorce. So those three areas.
So what is the CDFA advantage?
The CDFA advantage is the total circle of services and journeys that the CDFA can apply their services to for couples in this way. And I like to describe it in terms of these key areas. We provide oversight and professional review for pre- and post-nuptial agreements. Our work is definitely a part of the financial projection for support, the retirement assets, the investment assets that the couple has in their marital affairs. We play a big part in bringing those negotiations to settlement as we're working with parties to try to identify what are the areas that are important in trying to build consensus. We also work within the process of mediation and looking at some of the implications there. Mediators work alongside us quite often in our work as they're facilitating those client discussions. And then finally, our role is very key in the post-divorce sector. As I make sure, I particularly do in my practice as a CDFA, I make sure that my clients are taking care of all the loose ends involved afterwards and making sure we're taking care of things such as beneficiaries, such as those bank accounts, such as change of the estate plan, some of these key things that you're so caught up in being done with a divorce that you don't realize, wait a minute, we're not done. So I make sure that we take care of the post-divorce task as well.
Okay. Tell you what, Karen Sparks, who is a certified divorce financial analyst. I will get that right. Stay with us. We're going to cut to a quick commercial break here. I want to make a quick mention here for the Transcendence Theater. Celebrate summer with vineyards, wine, food trucks, and award-winning performances at Broadway Under the Stars in Jack London State Park. Now, I'm going to make a personal mention for them because I saw them last year, and it was phenomenal. I don't know if you've ever heard of them or seen them, but there's, the Jack London State Park. It's an outdoor theater, and it was phenomenal. These guys are better than Broadway, and maybe that's why it's called Broadway Under the Stars. So check them out at bestnightever.org. You will not be disappointed. All right, here is our first trivia question. And again, Karen, I just want to let you know, if you know the answer to this, don't answer yet, because when we come back, we'll let you answer the question. Okay?
All
All right.
will do.
Yeah, we don't want to give the audience a hint ahead of time. All right. Here's the trivia question. In 1996 and 2000, who was the presidential nominee from the Green Party? All right. That's our trivia question. Call 888-912-1190. If you're the first caller with the correct answer, you're going to win that free tanning certificate, which is worth over $100. And you can also gift it to somebody. So that's a nice little gift. So here's our question. In 1996 and 2000, who was the presidential nominee from the Green Party? All right. Stay with us. You're listening to The Best of Investing. We're going to be right back. All right. So that is segment number 1. By the way, does anybody know the answer to that?
Al Gore.
I don't.
Green Party.
That's Al Gore, isn't it?
Wasn't he a Democrat?
Oh, that's right. I'm thinking green like the environment.
Oh, gotcha. Yeah. All right. This is 21st show. Having fun so far?
So far,
So far, yeah.
So we've got question 1 and 2 out of the way.
Okay. And Mary Jo, I had a question for you, a listener question. But you may want to have that other one because this was going to be, I've heard of reverse mortgages, but only recently. Are they relatively new? How long have they been around? I can ask you that, and you can still get into the new rules.
So also we should talk about, Karen, the silver divorce and how this is being integrated into your approach. Is that something?
absolutely, we can do that.
Yeah. So how should we approach that?
Just ask her a question.
Okay.
If you want to ask him, I assume it has to do with the older people.
Yeah, it has to do with using a reverse mortgage to divide the housing wealth.
Oh, okay. That's a neat idea. Yeah, sure. It feeds right into it. Okay. You ready? All right.
I am.
Okay, here we go. Well, welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mary Jo LaFaye, who's an expert in reverse mortgages. She's my co-host today. Let's see here. Trivia question number 1 was, in 1996 and 2000, who was the presidential nominee from the Green Party? Does anyone know the answer to that? I hear silence. Ralph Nader. Remember him?
Yes.
Okay.
Ralph, yeah.
All right. So on the telephone, we have Karen Sparks, who is a certified divorce financial analyst. And by the way, Karen, are you an attorney or specialty just in finance?
I'm a specialty just in finance.
Okay.
I have completed my law degree, but I am not licensed to practice law. I do not practice law.
Okay. And I know Mary Jo has a couple of great questions for you.
Yeah, Karen. So I'm wondering if you could talk a little bit about the services of a CDFA and how those can be applied to different practice areas like litigation, mediation, and so forth.
Absolutely. So starting with litigation, the CDFA has training and ability to work in the aspect of an expert witness, doing business valuations. I'll speak from my own practice, and then I've done a great deal of that here in the Bay Area in Santa Clara County. I've prepared marital standard of living reports, business valuations in order to determine income, and so forth. So the CDFA can be a strong ally for attorneys and other professionals as they're preparing those family law cases for trial. So that is certainly one way in which it happens. Another way in which it happens, and I alluded to it in the previous question, had to do with mediation. And what we bring to the mediation process for couples who seek that as a method of journeying through their divorce is we are able to step into that process and provide that clarity, because oftentimes in the mediation process, where they hit the speed bump is, of course, over the finances. And all mediators don't feel comfortable getting into that or are not sure what all the nuances are. So this is a place in which the CDFA comes into that process and helps the parties through that. Another that you might have heard a lot about is the collaborative process. And within that, you have families who are seeking to take their divorce offline and are engaging in their negotiations outside the court system. CDFAs are a part of that process as a financial neutral. We are the ones servicing the parties, working through the data, and working through those negotiations in the collaborative process. And finally, consulting, which is something I do a little bit of here and there, is where I'm brought in, again, to maybe review a prenuptial agreement, or someone's having me look at their marital settlement agreement because now some changes financially need to be restructured for some things they didn't actually anticipate at the time that agreement was being held. So oftentimes you might be called upon to review the financial arrangements in various settings. And so those are some of the areas, Mary Jo, where we can be impactful in the divorce process.
Yeah, how often do you look at anticipated settlements and have big red flags where you have to say, whoa, wait a minute, you guys didn't think about this?
I would say quite often. I would say that most people try their best to do a good job with that, but oftentimes a lot of the details that folks don't think about are left out, and that's what our role is.
Well, like taxes.
Taxes, for example. We're looking at taxes. Maybe you're not looking at the long-term effect of how that particular decision is going to play out in terms of your net worth or your ability, for example, to maybe hold on to an asset such as the marital home. I'm just listing some
sure.
general things that come to play. But quite often, there are items that are missed and not considered, or maybe not considered well enough in a marital settlement agreement.
Sounds like there's a pretty wide array of things you have to look at. Can you share a few case studies with us to illustrate how a CDFA, the process is applied to real life situations?
Absolutely. I have a couple that I can share with you. A family that I finished with a couple of years ago. One of the key issues was the husband was very concerned about his retirement assets. This was key. And they also had properties in another state. There were conflicts about whether those properties needed to be sold or whether the wife was going to hold on to those properties and continue to invest in them. So those negotiations were quite challenging. But at the end of the day, I was able to work with both of them on a solution that, again, addressed their priorities. One of the key factors of my practice in all of my engagements is to make sure that I'm leaning into the priorities of the clients. So we were able to develop a situation wherein she agreed to take less of the retirement assets because her desire was to hold on to that other property to invest and to take care of. It ended up being a win-win for both parties. So that's one example. Another example is a situation in which the wife was the high wage earner, the husband was a lower wage earner. However, his concern was his medical insurance, his concern was livelihood after the divorce and so forth. And what we were able to do in that case is from the proceeds of the marital home, we were able to satisfy a lot of his concerns, particularly with having enough money to then take his own health insurance and take care of that. And we were able to then talk about a lump sum spousal buyout that would give him additional cash. And the wife was able to keep her retirement accounts with her employer. And we were able to structure all of this actually from the sale of the marital residence and be able to have both parties be able to still take monies away from that sale.
Let me ask you something here. How do you charge for your services? Is it hourly, like an attorney, or how do you do yours?
I have structured mine in flat fee retainer services, and they are based on certain amounts of time, as I have found that it takes a certain amount of time to get through various tasks at certain levels of difficulty. And if we do come close to exceeding that time or close to the time that we've retained together, we then can look at that agreement and add more time at my hourly rate. But my clients really enjoy having the flat fee arrangement. They know what the parameters are of payment, and there's no guesswork in it. And I generally provide clear billing records for all of the work that I do in all of my cases. The clients are really able to kind of see how their money is being spent.
And Karen, in case the audience wants to get a hold of you, if they have questions about divorce and finances, how do they get a hold of you?
First of all, you can reach me by phone, area code 650. The number is 201-6311. Please feel free to reach out to me by email as well, and that can be done at C as in Charles, D as in David, F as in Frank, A Apple, so CDFA at Divorce Financial Strategist with an S on the end.com.
Very good. Karen Sparks, thank you so much for joining us on the Best of Investing today.
My pleasure to be here. Really enjoyed it.
Thank you, Karen.
All right. That was good. It's good stuff. I mean, you got to get specialists in on certain areas, and with divorce, I mean, there's all kinds of issues to talk about. Let's see here. Okay, we are going to cut to another quick commercial, and we're going to ask our trivia question number 2. And then when we come back, we're going to talk a little bit more in depth with Mary Jo LaFaye about reverse mortgages. It'll be very interesting. Here's our second trivia question. What U.S. territory's official motto is "Where America's Day Begins"? All right. Call 888-912-1190. Or for the first caller with correct answer, you're going to win that tanning certificate. What U.S. territory's official motto is "Where America's Day Begins"? All right. Don't touch that dial. You're listening to the Best of Investing, and we're going to be right back. Okay. All right. Well, that was good. Let's see here. Save as. All right, ready to get into some reverse mortgages?
Mm-hmm.
Having guests is great. It's always, because it gives variety.
Mm-hmm.
But we want to make sure that we give you enough time.
much time do we have left?
Oh, so we've got two main segments, 8 minutes and 10 seconds, 9:17, and then we've got 5 minutes and 10 seconds closing out. That's for a second here. Why don't I start in with the email question, and then you can move right into
What's the email question?
which is, I've heard of reverse mortgages, but only recently. Are they relatively new? How long have they been around? A lot of people still haven't heard of it.
Really?
Yeah, surprisingly.
Oh, okay.
Yeah, I mean, it took a long time for people to go, oh, what's a home equity line?
Right.
Yeah.
Yes, there are people that still don't know what that is.
It's true. In fact, we had one guy who wanted to borrow money. He was a really nice guy and he was honest, but he said, I need a second mortgage and we're going to keep the first in place. And when we pulled a preliminary title report, there was a first, there was a home equity line, and then he wanted a loan behind it.
Mm-hmm.
And we said, do you understand that you're asking us to be in third? He goes, no, you're going to be in second. I said, well, what about your HELOC? And he says, oh, yeah, but that's just a HELOC. That's just a home equity line. I said, do you understand that that's a real mortgage behind?
Yeah.
He just
No,
didn't
I have
understand.
people call me all the time and say, my house is completely paid off. And then
And
we
then
find out, oh, but you owe $250,000 on the HELOC.
Yeah,
Well, I paid my house off 10 years ago.
exactly.
Okay, well, you've spent $250,000 since then, so we have to pay that off.
I mean, do they forget that they have it?
No,
I mean,
they
'cause
just
make
don't
payments
think
on
of it
it.
as a mortgage.
Yeah.
Some of them don't even realize it's secured by their house. They forget.
Home equity line.
Line of
Yeah.
credit.
Oh, it's based on the equity, but they don't have a mortgage.
Right,
Because
yes.
the bank just says, you know what, we think you're nice people and you have a lot of equity.
You have a house, so you must be okay.
Exactly.
Yeah.
That's it. It's
That's
like,
how banks operate.
yeah, exactly. All right, you ready?
Yes.
Here you go. I have to make a quick mention here for this. So we'll answer a trivia question, get into this, and then we'll get into that. Here you go. Welcome back to the Best of Investing. Again, I'm Edward Brown, your host, along with Mary Jo LaFaye. That was a good segment with Karen Sparks. And we're going to go to our second trivia question. What U.S. territory's official motto is where America's day begins? So this would be a U.S. territory, so not a regular state. And that would be Guam, where I guess that's where the first part of America starts its day. All right, so I want to make a quick mention here for the Renaissance Indian Wells Resort and Spa, which is a desert oasis for the family getaway in the Coachella Valley. It's the perfect place to recharge and relax poolside in the sandy beach area, or send the kids off for a day at let's try this again. Send the kids off for a day of fun at Camp Oasis. The world-class resort features a well-appointed guest rooms, 5 restaurants, and a rejuvenating spa. Plus, if you book your summer family getaway today, your kids eat free. See REN IndianWells.com. That's RenIndianWells.com for details. You can also call 760-773-4444. So, Mary Jo, you are an expert in reverse mortgages, and we have an email here that comes in to the Best of Investing and says, you know, I've heard about reverse mortgages, but only recently. Are they relatively new? How long have they been around?
Well, my answer to that would be compared to what?
You mean the word relatively
Yes.
new? That's a good point.
They are relatively new compared to the
Landing of
age
Columbus.
the age of the universe. But no, they're not really relatively new, although there have been so many changes over the last few years that the reverse mortgages that we have available today are relatively new because they're so different. I say they're the revamped version of the former reverse mortgage, kind of like the former Prince. So they now have a financial assessment to help borrowers guarantee that they'll be able to pay their property taxes and homeowners insurance during their life expectancy. That's called a life expectancy set aside. And that money is, if people choose, or if they don't have the capacity to pay their property charges on their own, then we can set that money aside for them.
So in a typical reverse mortgage, either someone's given a lump sum or they can take like annuity, right?
Or a line of credit.
A line of credit.
It's not really an annuity. It's a monthly payment of any amount that they choose.
Gotcha.
Or they
Okay.
can choose a lifetime monthly payment called tenure.
Tenure.
Like
Okay.
a professor that has tenure.
Yeah, exactly.
Never go away.
Okay.
So there's no annuity purchase or anything like that associated with any of the reverse.
Yeah, I think I wasn't thinking of annuity purchase like
Right.
insurance. It's just like the word annuity.
Yeah.
Okay.
Right.
So what happens in that case? Because again, property taxes and insurance have to get paid.
So we can set aside some of those available proceeds for them if they choose. And some people like the idea that that responsibility is put on the lender. So when they get older and maybe become a little bit more forgetful and don't remember to open their mail and pay their bills, the lender's on the line to pay those for them for their life expectancy. So that's a growing interest that people have. And also if they have a history of not paying their property charges, then of course HUD would want us to set that aside to make sure that those are paid on their behalf to protect them.
So that goes into the calculation of how much they'll get.
Right, yeah. So if their property charges are $2,000 a year, which is common around here because of Prop 13, and they have a life expectancy of 12 years, then that would be approximately $24,000.
And what if the borrower says, no, I'll be responsible for it myself?
If we can show that they have the willingness and capacity to do so, meaning a history of doing so and sufficient income, then that's fine.
And what happens if they, do forget to pay the taxes?
They will be notified promptly.
Okay, and what's the penalty for not paying them on time, besides what the government charges?
Well, the lender could take money out of their line of credit and pay them for them.
Gotcha.
Yeah, so
Okay,
it's really important that people do pay their property charges
Of course.
on time. Those are kind of the main tenets of having a reverse mortgage. Is you're not responsible for much. We don't have to qualify you to make a mortgage payment because there's never one due.
Yeah.
But we do have to qualify you to pay your property charges, and you want to make sure that it's a house that you want to continue living in, at least for a few years if you're going to go through the process of an appraisal and closing costs and so forth. Yeah,
is there a magic date, so to speak, like 3 years? Is that the cutoff?
It's funny because some people, anybody that wants to obtain a reverse mortgage has to go through a 1-hour counseling session by a HUD trained counselor, and they're instructed to tell people that you don't want to do a reverse mortgage unless you're going to be in your home for 5 years. But I like to take a little bit more analytical approach and say, okay, what are your other alternatives?
Sure.
If you don't do a reverse mortgage,
good point.
What else are you going to
do? Yeah, if you need money.
So it's really easy to say, if then, but really you need to sit down and look at the numbers and what are the alternatives. And so maybe you want to, take in a roommate instead. Yeah, because
the way specifically with Dodd-Frank, but even before that, if you did not show the ability to repay, you didn't just automatically qualify for a home equity line just because you had equity.
Yeah, exactly. Yeah. And, I've had people that say, well, there are closing costs involved in getting a reverse mortgage. So, the counselor, the HUD trained counselor told me not to look at it unless I was going to be here 5 years. But then, over those 5 years, even maybe they only stayed 2 years and their house went up in value, $100,000 or $200,000. So that, of course, kind of makes the closing costs irrelevant. So it really depends it has to be looked at on a case by case basis, in my opinion. And what are your other alternatives?
See that, and that to me is the key. And that's what I always think of with investments in general is alternatives. If I don't do this, what else am I going to do?
Exactly.
Put the money in the, so for investments, you have choices. Safest thing you can do is put the money in your hand because it's there.
Right.
But you don't earn interest on it. So the next riskiest thing, is to put it in the bank.
Yeah.
And but then you keep going up the ladder, and it's alternative A or B.
Right. Yeah. So, and for some people, just knowing that they have that large pot of tax-free money available to them if they have a health crisis or anything, that they want to help one of their adult children buy a house or send a grandkid to a private college. There are a lot of things that people like to do, and they like to have that money available. Yeah,
because how does that work with regard to, with some people when they have to go on like Medicare or something, don't they look at the assets and say, well, you don't qualify because you own too much?
I don't think your primary residence, I'm not an expert in that field, but I don't think your primary residence value is considered.
Okay.
And your reverse mortgage line of credit available cash is not an asset. It's available loan proceeds. It's kind of like having a big credit card attached to your house.
Yeah, that's exactly what it is.
Yeah. And the big benefit with the reverse mortgage line of credit is that it cannot be frozen, reduced, or canceled at the bank's whim like a HELOC or a home equity line of credit.
Good point, because the bank can do that.
Yeah, in 2008,
Uh-huh.
they froze over $6 billion of HELOC credit in June of 2008.
And in some cases, they just lowered it. If you didn't use, in fact, one time I had a mortgage broker call me and said, Edward, you better use all your line of credit because they're probably going to limit it.
Mhm.
Yeah, exactly. Okay. Trivia question number 3 here is New Hampshire, New York, and Massachusetts are the 3 states that border which state? So what's the state that these 3 states border? New Hampshire, New York, and Massachusetts. 3 states that border what state? Call 888-912-1190. Be the first caller with the correct answer. You're going to win that tanning certificate, which again is worth over $100. It's a very, very nice gift that we're giving away. All right, don't touch that dial. When we come back, we're going to continue on with Mary Jo LaFaye, reverse mortgages, and I'll give you an update on Pacific Private Money and how the fund is doing. All right.
How is the fund doing?
Pardon?
How is the fund doing?
Very well. We are up to 42 million. Average loan to value is under 60%. Still no losses, and we're paying about 7.75%. Very well.
What happened to the fund in 2008, or did you have one?
The fund started in 2013, but in 2008, Mark's company was making loans while the market was going like this, and there's still no losses. Because
Really?
if you think about it, if let's say a loan was, let's say there was a house worth $1 million, and you made a $600,000 first deed of trust, a 12-month loan. Well, in 1 year, the properties did not go down 40%.
Right.
So if they went down 20%, which would be just a disaster, there was still so much equity in there, people were still able to refinance.
And what was his company?
Pacific Private Money.
Oh.
Yeah, it's just that he started a fund in 2013.
So what was it before?
It was doing one-off deals.
Just with his own money?
Well, no, he was brokering. So like you would go and you'd say, hey, I've got, $300,000 to invest.
Yeah.
And he'd find you a specific deal. Now he's got the fund, so it's like a mutual fund.
Right. Yeah, I knew a guy. You know Pete Klein? He had a big fund in Palo Alto, big office building down there. He bought big fat house in Half Moon Bay, lost everything.
In 2008, no what? So you must have had too much leverage. See, and our fund is not leveraged.
Yeah.
I mean, we say it's not leveraged, but we do have a line of credit to close deals. And then when investors put money in, they immediately pay down the credit line.
Right.
So it's just temporary. We just want to make sure to make that clear to people because they see you, oh, you could borrow, and they say, well, yeah, but there's a specific purpose for that. And it's only $2 million compared to the $42 million fund. So
5%.
Yeah, and the reason they do it is because if let's say you like the idea and you want to be an investor, if you put $300,000 in today, unless there's a deal sitting on the table for that money to go in, it's just going to sit in a side account, earning practically nothing, waiting like when's the next deal, and we got a deal.
In what case does that happen?
If we didn't have the line of credit, and you said, you know what, I like this, I'd like to invest.
Oh, I see what you're saying. Yeah.
Yeah.
You just put your money to be on reserve.
Exactly. Yeah. Because if you think about it, let's say you walked in with $20 million. I mean, that would dilute the fund like crazy. It would be unfair to all the other shareholders. So what they do is they put it aside, and then as they need money to do a loan, so maybe of your $20 million, $1 million got used this week, and $1 million next week, or whatever.
Yeah. So you fund it with a line of credit, and then you say, hey, we've got a loan to pay off.
Basically, yeah. So that's exactly what it is. So that way you can have your money work a lot faster. And the interest rate on the loan or the line of credit is like 6%. So there's a little bit of arbitrage, but they're not using it for purposes of that.
What's the maximum you can charge somebody without being like usury?
We're not subject to usury because we're mortgage brokers. We have a license. Yeah, if you're unlicensed, then the most you can charge is 10% in California. If you charge, if I just said, well, I'm licensed, but let's say Joe, your friend, says, hey, I'll lend you money and you only have to pay me 11% interest. You said, that sounds great. Well, if he's not licensed, that's usury, and any payment that you may, I'm not an attorney, but I'm pretty sure this is a rule. Consult your attorney on this. Any payment that you made toward that interest is basically all principal. He basically made you an interest-free loan. So if a person who wants to lend money to somebody, if you're in California and you're unlicensed, don't charge more than 10%.
Interesting.
Yeah.
And can you charge points if you're not licensed?
No, it's basically all part of that.
Part of the 10%.
Yeah, and then so the APR. I mean, if you charge any points,
It has to be 10% APR.
Yeah, and so that'll even make it worse. From worrying about it.
Yeah. Interesting.
But we are limited in looking still at ability to repay for certain things, with owner-occ loans, but we do have a bridge loan.
Oh, you can do owner-occ loans?
We can do, yeah. We're one of the few lenders who can do owner-occ.
I just got an email from a guy in Southern California that said they can do owner-occ hard money loans, and I was like, I have to show that to Edward.
Yeah.
So how do you do that?
Well, it's very expensive to get the software, the licensing, because you have to have NMLS license. The legal, Pacific Private Money spent all that money to get licensed. A lot of hard money lenders said, you know what, I'm not spending all that money and the continuing education.
So it's a different license.
Yeah, it is.
For owner-occ.
For owner-occ, yeah. And then you have to still follow within certain rules. So just because you have a license doesn't mean you can still make the loan.
You have to show that they can repay it?
Yeah, but there's certain exceptions, and they get a little bit complicated on stuff. But we've run through legal counsel, and so we have a specialized project.
That's good to know.
Yeah,
I need to know more about that because I have clients call me that are in foreclosure.
Yeah, so we can
yeah.
There's a lot, and we
usually have a lot of equity.
Yeah, if they have a lot of equity, the question also is like, why are they in foreclosure?
They don't have any income. They got these big loans, and when loan money was easy, and they've been refining, and now they've run out of money to make the payment.
Yeah. Now there are certain things we can do it on a purchase. If there's a refinance, then I'm not the expert on the Dodd-Frank rules.
Usually they need a second to pay off their back payments. They might be a year and a half behind on payments.
And do they have any income at all?
Oh yeah, I bought one in Corte Madera that they got $5,400 a month in income.
Okay, send it my way. We'll take a look at it. If we can legally do it, we will.
All right.
Yeah, and then also send me the stuff on the Southern California, because there are a couple of people. We're not the only one.
Sammy Stein. He's
But
on
which
LinkedIn.
company?
I don't know the name of his company. I can look it up though.
Okay. And he specifically is talking about consumer loans, not just putting up your personal residence, because there's a difference between like what the money's being used for.
California Hard Money, Private Money Direct Lender, Marquee Funding Group.
MARQ. So he's got the NMLS.
That's my license.
Oh, that one's yours?
Yeah, no, that's I'm licensed through NMLS.
Oh, okay. And so gotcha. Okay,
Yeah.
so is he? Yeah. Group. California. I fund owner-occupied consumer loans. Okay, so yeah, this would be it. Okay, yeah, I'll look them up, because sometimes we partner with companies.
Mm-hmm. Cool.
Sometimes that someone, or sometimes they don't have enough money at the time, but we do, and vice versa.
Right.
So yeah.
Yeah, you can farm it out and make a little money. He's been sending me stuff for a long time. I don't know how we got connected on LinkedIn.
Okay, good. All right, you ready?
Yes.
Do you want to talk about the silver hair?
The silver.
Silver.
Silver divorce.
Oh, silver divorce. It's silver hair.
There's two things I want to talk about.
Okay.
The jumbo reverse mortgage has a new flex option. You don't have to take all the money at once. You can receive the money over 60 months.
Okay, why don't you explain that?
And then silver divorce, buying out, dividing the house.
Well, I'll just say you've got a couple more topics to cover. How's that?
Okay. And so this is, are we on the 9 minutes?
9-minute segment, yeah. And what we'll do is just cover our last trivia question. Go ahead,
Okay.
answer. Here we go. Welcome back to the Best of Investing. One more time, I'm Edward Brown, your host, along with Mary Jo LaFaye. I like saying that. Mary Jo LaFaye. Rolls right off the tongue. Third trivia question. New Hampshire, New York, and Massachusetts are the 3 states that border which state?
Connecticut?
No, actually, it's Vermont.
Oh.
Vermont. Okay. I know, we wish it was Connecticut.
Yeah.
So Mary Jo LaFaye, you are the expert in reverse mortgages, and there's a couple topics you wanted to cover.
Yes, actually we have two big pieces of news. The first one is the jumbo reverse mortgage, which I've spoken about before, and that's a large part of the business I do because of the area that I serve. I tend to have clients with really high value homes, and they have on average mortgages from $200,000 to $800,000 that they'd like me to pay off for them, so they don't have to make those monthly payments anymore, which get to be extremely inconvenient when you're living on retirement income.
Yeah.
So the new jumbo reverse mortgage, the interest rate went down from 7.8 to 5.99.
Wow.
And that's a fixed interest rate. But the big news is, even after they lowered the interest rate and they raised the available loan amount to $4 million, so now you can get $4 million that you don't have to pay back for the rest of your life, as long as you continue living in the house and paying your property charges on time.
Now that, of course, means your house got to be worth quite a lot.
Oh, at least $100.
Yeah.
Or 10 million.
Or 10 million.
Whichever's more.
More. Okay, there you go.
So the big news with the jumbo reverse mortgage is that you no longer have to take all the money at closing. So that was kind of a big hit if somebody was borrowing, $1 million or $2 million, and if they didn't need it all to pay off an existing mortgage, then they would have to start accruing interest on that money right away, and they wouldn't have to start paying it, but it would be accruing against their equity.
And unless they placed it in a higher interest account, they were having negative arbitrage.
Yes.
Not a good thing.
Not a good thing. So that was kind of causing a certain amount of people to shy away from taking advantage of the high loan proceeds and the deferred repayment. And of course, they're all non-recourse loans, which is huge. But the new feature is that they now allow you to spread the payments that you receive over 60 months. So you have to take a certain amount at closing, and usually that goes to pay off people's existing mortgage.
Yeah.
So their mortgage payment will go away. And then the remaining amount you can spread over payments of 60 monthly payments. And the great thing is, if you decide to take that additional money over the next 60 months, and then suddenly you need it all for some purpose, you can just accelerate the payments. So you can take it all at any time. So you're not locked in to whatever you choose to do.
Didn't it used to be that you had to have a free and clear house to do it originally?
It did, long time ago. Yeah, when they were done by insurance companies and they required you to purchase an annuity and all that your house had to be unfree and clear.
Yeah.
That's rarely the case anymore. Most people, especially in California, they have so much equity. The average American is retiring with 70% of their net worth held in the form of housing wealth.
That actually makes sense.
Yeah. So over time, they tend to tap that for health issues, in-home care, a spouse's nursing home care, sending kids to college. They just, remodeling their kitchen, different things come up and people tap that equity. Then they hit retirement and they say, oh, wow, this payment seems a lot bigger now that our income is cut in half.
Yeah.
So we like to set them up for success and help them get rid of that monthly mortgage payment, so that if the market takes a dip again, the stock market, and their income may go down, maybe they don't want to draw so much from their investments when their value is lower. So not having a mortgage payment can help them increase the probability that their money will last for a 30-year retirement.
Makes sense. And you wanted to talk about the silver, not the silver fox, not the silver hair, but the silver
divorce.
Silver divorce.
Yeah, and it's funny because it used to be referred to more often as gray divorce. Yeah. But Dr. Barry Sachs and I have done a lot of research together and written a few academic papers together. And we decided, it was actually Barry, I think, that came up with it. He said, gray divorce, that's just depressing.
It is.
It's depressing enough to be 72 and getting divorced, but for it to be gray, he said, let's make it silver. That's sparklier.
That's true.
And so it's kind of caught on, and I've actually seen other articles being written about silver divorce.
He should have patented it.
Yeah, he should have.
Trademarked.
He's patented a lot of things, actually, but I don't think he's patented or trademarked that.
So
anyway, we've done a lot of presentations to different professional organizations, the matrimonial lawyers and the Institute of Divorce Financial Analysts and the National Association of Professional Financial Advisors. And they're very interested in silver divorce because dividing housing wealth for retirees that are getting divorced is really a crucial part
Oh,
of
yeah.
the picture.
Well, it's probably the biggest asset.
Yeah,
And it's not as easy as just, okay, we sell 100 shares of IBM and split the proceeds.
right.
You know, you're talking
Then
about
you
a house.
have taxes and all sorts of things.
And usually, doesn't one spouse want to stay in the house?
Typically, one spouse wants to stay in the
Yeah.
house. Yeah, and so we can help that spouse that wants to keep the house do a cash out refinance with a reverse mortgage. So they pull money out of the equity to pay off the departing spouse,
Yep.
but they don't have to make a payment. So it doesn't change their cash flow. So here they went and bought half of $1 million house or half of a $2 million house without putting out any money. They haven't had to take money out of their investment portfolio. They
Yeah.
haven't had to give up any of their retirement assets. Nothing. It's just a painless, sort of painless after the underwriters are done with them, transaction. And then the departing spouse takes their lump sum that they got from the spouse that wants to keep the house,
Mhm.
and they use that as down payment money towards the purchase of their home,
Yeah.
which they pay off the balance with a HECM for purchase. And now they have no mortgage payment. So now you have two retirees with home ownership, and neither one of them have a mortgage payment, and neither one of them had to take money out of their income producing assets to achieve this.
That sounds very promising.
It's like a Christmas miracle.
Yeah. But before I forget, how do people get a hold of you?
I am most easily reached at my office here in Marin County, and my number is 415-259-4979. And of course, you can find lots of information about me if you just go to maryjolafay.com. That's MaryJoLA, F as in Frank, AYE.com.
Very good. So Mark and Nam are not here today, but I wanted to give a little update on the Pacific Private Money Fund, of which I have some of my retirement fund in, and I'm very happy. Current yield is about 7.75%. It's paid on a monthly basis, so what I earn in a month is more than what I've been earning in a year on some bank accounts. And the average loan to value in the fund is still right hovering just below 60%. Still no losses. Some of the loans that we've been seeing recently have been pretty smoking hot. It's pretty amazing. They still say no 90% of the time, but the 10% that they say yes to are very choice loans. Some of the loans are like 25% loan to value. Some are 70% loan to value, but all in all, very, very conservative. Also want to make sure that it's mentioned that the fund makes loans primarily in California, mostly in the Bay Area. There are a few loans that are outside of California, but the reason is because the borrower is inside California and put up actually notes themselves. They're actually hypothecated notes on properties in like Minnesota, but the loan to values are still really good. It's people who lost their homes, and then this company goes in and helps them repurchase the home, and then takes a mortgage.
Wow.
And then so this company puts up as collateral that first deed of trust, and so far it's worked out very, very, very well. So
Sounds like the Mother Teresa of mortgages.
in a sense, it really is. I mean, it's funny, rather than being the guy with the curly mustache and top hat, putting people under railroad tracks. It's actually it's more the Mother Teresa type. I mean, it's fairly expensive. It's not cheap, than a regular bank loan, but
very profitable Mother Teresa.
Yes, exactly. Yeah, Mother Teresa with the dollar sign.
Yeah.
So anyway, best way to get a hold of them, pacificprivatemoney.com. Their phone number is 415-883-2150, and inquire about how you can invest with them. When we come back, the best of investing, we'll have some closing comments. All right.
And so I was saying something to my boyfriend the other day about, this client and how I was, really, really able to help them, and it felt really good. He goes, "You're not the Mother Teresa of reverse mortgages." I said,
Nice
"Oh,
guy.
yes,
Come
I
on.
am.
Yeah,
Oh, yes,
are.
I am." I said, "What do you mean? Of course I
That
am."
wasn't very nice. Yeah, I mean, okay. Gee, just because you make it money off of it, I mean, that means, that's evil.
Yeah, no. He's a mortgage nerd. He's
Oh,
at the
okay.
other end. They hedge interest rates for mortgage companies.
Oh, interesting. Okay. So
So
he
he
was a little bit
sees
more
the
tongue in
profit
cheek.
on the back end.
Yeah.
She's like, "Oh, this thing's got a lot of money."
Well, it's interesting. There's been some fallout with loans requests. So people found money cheaper. or mom and dad came up with the money.
Really?
Yeah. So we give a loan commitment, but you can't force anyone to take a loan.
No, unfortunately not.
Yeah. Which just gets annoying because you put some time and
A
effort
lot of
into
time.
it.
Oh man,
Yeah.
you wouldn't
Oh,
believe
I
the
go
time
with
I
you,
spend
it's
with
even more.
clients. I drive to San Jose and sit in their kitchen for 2 hours. I mean,
That
that's my
I don't know how
entire
you do it, because that would actually drive me bananas. I used to do that when I used to, I still do some insurance sales,
day. Mhm.
but going to people's houses to try to sell them term insurance back in the old days,
Yeah.
it's like, really?
Yeah.
Come on.
I
Okay,
usually try to stack them, so I've got like 3 or 4 people on the peninsula in one day.
that's
Yeah.
the only smart way to do it.
Yeah.
I got a couple of like deals of the week to go over.
Yeah, I don't have anything else to say.
Oh, okay. Yeah, we'll go over some good stuff. Here we go. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with my special co-host, Mary Jo LaFaye. She only comes on once a month, but it's always special when she comes on. Thank you very much for joining us.
You're welcome. It's always fun.
Okay. So I did want to make a couple of interesting comments here about some of the loan requests that we've been seeing, or they've been seeing at Pacific Private Money. It's amazing. The loan requests are these people who, again, kind of typical, where they own one home, they want to buy another home, but they can't quite qualify, usually because the bank doesn't like to see them own 2 homes. But we're seeing loan requests that are 25% loan to value. They have $1 million. They're wanting to buy $1 million home. They have $750,000 they can put down, and the bank won't lend them $250,000.
Why not?
Because the bank says, well, wait a minute, you haven't sold your other home yet. And even though
Right.
they have a lot of cash to put down, from other investments or whatever, banks just kind of are kind of screwy that way.
Well, I hope they find you.
Oh yeah. So again, we get a lot of referrals from mortgage brokers, reverse mortgage specialists. Because again, for one reason or another, maybe the person doesn't fit into the box
Right.
of the HECM, as they say. We get referrals from banks. Again, banker doesn't want to lose the deal. But interestingly enough, so people who want to invest in the Pacific Private Money Fund, here's the catch. You have to be an accredited investor. So that means you have to be worth $1 million outside of your home, or you have to make $200,000 a year if you're single, $300,000 a year if you're married.
Mhm.
For those people who don't qualify, they still like the idea of being the bank, basically, and earning a good rate of return of over 7%.
Right.
Pacific Private Money has a new website called privatemoneyloans.com. You have to register first, and then you get to see, it's like a little smorgasbord grocery store of what loans they've put on their platform, and then you can buy either an entire note or you can be a participant. So they're allowing, you have to buy at least 20% of a deal. So if there's $100,000 mortgage that's there,
Mhm.
you can invest, but you have to put in at least 20,000. Well, that's doable for most people.
And
And
those
so-
are what loan to value are those?
They'd be the same kind of what's in the fund.
Mhm.
So what the fund has done is they'll take a loan, they'll fund it.
Mhm.
Sometimes what they'll do is they'll give a commitment, and then they'll put it on the platform as a live funding. But
Mhm.
many times they'll have funded the loan, and then after the dust settles, then they'll put it on this platform. Now, why would they do that? Well, they're going to take a servicing spread.
Mhm.
So they make money, and the neat thing is they split that fee with the fund. So the people who are in the fund are actually making a little bit of extra income, and then it frees up some money for them to go do another loan.
Right.
So it's a nice little kumbaya.
Maybe a bigger loan.
Yeah, exactly. Yeah,
So
or just getting spread.
And what are the people on the non-accredited
Okay.
participants? What do they earn?
Generally speaking, they'll earn just a little bit less than what they would in the fund. So, but it's still in the 7% range. Every once in a while, there might be a loan in there that might pay 8%.
Mhm.
And but it's good and bad. I mean, you don't have the diversification because you're in just that specific loan.
Right.
And if that loan doesn't pay for X period of time, then you're not going to get your income
Right.
until things get resolved, either
Right.
through foreclosure or
Mhm.
a loan workout. But you can kick the bricks. You can actually see specifically where your money's going.
Mhm.
The other thing is there's some people who don't want to participate with other people they don't know.
Right.
Because in that case you have a fractionalized deed. So
Yeah.
I mean, there's pros and cons to both. But anyway, you want to check them out at pacificprivatemoney.com. And Mary Jo LaFaye, thank you again for joining us on The Best of Investing. Good, that was very good information about reverse mortgages.
Thank you.
Here's our thoughts for the day. Knowledge of what is possible is the beginning of happiness.
I like that one.
Like that one? And this one's even better. And try to be a rainbow in someone's cloud. And with that sappy thought, every once in a while I gotta get a little sappy here. See, if I did this with Mark and Nan, they'd probably slap me silly,
Right.
you know. But I figured Mary Jo LaFaye would be very appreciative of these nice.
That's right.
Nice
I like
thoughts.
rainbows.
You like rainbows?
Unicorns.
Yes, exactly. Okay. Tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening.
Thank you.
You're very welcome. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.
So the transgender theater, Broadway Under the Stars. So
No, not transgender. Transcendence Theater.
and that's where it's at Jack London State
Well,
Park.
yeah, they do them all over. They've
That's
had
in
it
Sonoma.
at, near Glen Ellen.
Yeah.
Yeah,
Okay.
they've done it
Okay.
at the Civic Center. You know, they've had different ones. And I mean, I'm really honest with you. I've seen at least 4 shows, and they're excellent.
And the one right now that's playing
Is Jack London Square or August like 3rd, 4th, 5th? You just go on to
bummer, I'll be out of town.
well, but they have other showings
But
too.
which is the okay? I've got 3 things right now: Transcendence Theater, Broadway Under
Yes.
the Stars, and Best Night Ever. Which
Okay,
is the name
so
of
Transcendence Theater is like the company. Broadway
Okay.
Under the Stars is the name of the specific show that we were talking about.
Oh, okay. That's
And
the
then
show.
their website, if you just go to
Uh-huh.
bestnighthever.org,
Right.
you can see all the various shows that they have.
That's the website for the Transcendence Theater.
Exactly. And with that, we are going to say goodbye on the live stream.